Is a recession coming or not? This is a question I've been asked more than any other by executives and directors of financial institutions over the past 6 months, really going all the way back to the failure of Silicon Valley Bank. And when I'm being asked this question, they're really not interested in my opinion. They're really asking me a different question. And the real question they are asking me is, how do I possibly manage my bank or my credit union for the next 2 years if I have no idea on whether or not a recession is coming? Usually I have some idea. Now I have no idea, and there's a lot of smart people out there predicting a recession is going to come. Now, this is a very tricky question because on the one hand, you don't want to put your financial institution at risk unnecessarily. On the other hand, you don't want to miss out on opportunities either. Predictions of a recession being imminent have not aged very well. And in fact, it doesn't even feel like a recession's anywhere near to being around the corner. If we look at GDP, it's on fire right now. GDP in the third quarter came in at a 4.9% clip. The unemployment rate still has a 3 handle on it. And even when we consider asset quality metrics in the banking industry, those are still below or at worst on par with pre-pandemic levels, which they themselves were at historic lows. At the same time, the circumstantial evidence indicates that a recession could be imminent, but it's all circumstantial evidence. First of all, interest rates have come up so much, so fast, we still haven't felt the full impact of the rate hikes that have already happened. And when you look at all of the debt across the economy, there's a lot of it that is going to reprice or need to be refinanced in the next several years at much higher rates, especially commercial real estate, which a lot of smaller banks have exposure to. So we don't know how that's going to play out. The yield curve is the best predictor of a recession. It has predicted each of the last 8 recessions. And when the yield curve inverts, that's when it's trying to tell you a recession's imminent. Well, guess what? The yield curve is inverted right now, and it's inverted quite sharply. And it's been inverted for almost 16 months. And it is screaming a recession is coming. And given its undefeated streak, we have to take that seriously. Do not underestimate the impact that quantitative tightening could have on creating a recession. Quantitative tightening is draining liquidity from the banking system. As that liquidity gets drained, many financial institutions are going to have to pull back on loan growth. Some are going to even shrink their balance sheets and be forced to deleverage. That deleveraging process could easily trigger a credit crisis and a recession. Given all those cross currents, it's very easy to get confused and be trapped by all of the uncertainty. But there is a way to be recession ready without being paralyzed by the threat of a recession either. And here's how you go about doing that. You need 2 playbooks, one for offense, one for defense. Just like a football coach. Your offensive playbook is your strategic plan. Your strategic plan should always be based upon whatever your base case forecast is. So you need a base case forecast. And if your base case forecast is we're going to have a soft landing, that is a very understandable and supportable base case forecast. And if that is your forecast, you are likely going to have in your strategic plan some offensive uses of capital. You are either going to be putting capital to work in the form of loan growth or M&A, or returning capital to shareholders in the form of dividends or stock repurchase. But in either of those cases, you are focused on deploying capital or returning capital to create shareholder value. But you also need a defensive playbook as well. And your defensive playbook is called your capital plan. And every financial institution must have a capital plan. Capital plans have generally been thought of as a regulatory exercise. I need to have this for my regulators when they come in for my next exam. It has really never been thought of as something that's going to be useful for banks and credit unions. Well, this isn't about regulators. You need to have a well-designed capital plan because that is going to provide you with the alarm system to effectively manage your bank and be prepared for a recession without having to overreact to the threat of one. If your capital plan, aka your alarm system, is well designed, it will not only tell you if but it will tell you when you may need to deviate from your strategic plan and transition to backup plans, which are designed to preserve capital and prioritize the preservation of capital over the deployment of capital to create shareholder value. The first level of defense in your capital plan should be early warning indicators. You should have around 8 to 12 of them in your capital plan. You don't want more than that because otherwise it will become white noise. The early warning indicators should predominantly measure the three major risks: credit, interest rate risk, and liquidity risk. Each of them should have a soft limit, which is like an early warning indicator for the early warning indicator, and a hard limit, which is something you refuse to accept going above or below than without taking action. Let me give you a few examples of early warning indicators that should be in most, if not all, of your capital plans. First, classified assets to capital ratio. My experience is that if this ratio gets anywhere near 50%, you are likely to receive an MOU or worse from your regulators. So you might as well have a trigger and a limit that are below those thresholds. Another early warning indicator that many of you should have should be concentration limits, especially on construction or commercial real estate if you are a bank deemed to have a concentration in one of those areas. All of you should have an uninsured deposit coverage ratio as one of your early warning indicators. That is a measurement of your on and off balance sheet liquidity relative to your uninsured deposits. That should be well over 100%. Many of you are becoming increasingly dependent on the broker deposit market and wholesale sources of funding such as the Federal Home Loan Bank for liquidity. You have to have a limit or tolerance for that dependency. That should also be in your capital plan as an early warning indicator. Now, one key point about not only identifying the early warning indicators, but setting the triggers and the limits. You don't want those limits too loose, and you don't want them too tight where they're choking you off. You have to set them as optimal as you possibly can. And the only way to do that is to use data and analytics. This isn't an analytical exercise is going to be required to do this. The second level of defense in your capital plan should be having internal limits and triggers for the regulatory capital ratios. Now, your internal limits and triggers need to be higher than the written regulatory minimums for a well-capitalized institution. But you also don't want them too high where they're unnecessarily encumbering capital that is basically going to earn you no return on investment. Your limits and triggers should also be lower than what's in your strategic plan. Think of them as guardrails or a cushion around your strategic plan. Now that you have your alarm system in place, you have your first level of defense, which are your early warning risk indicators, which are your internal regulatory capital limits. The question then becomes, well, what happens if your alarm system goes off? You may need to kick in some elements of your backup plan. Limit breaches should be taken very seriously. If you breach a trigger, it should force management to come to the board, disclose the breach, and then make a recommendation on whether or not action is required. Because if you breach a trigger, it could easily just be a temporary thing that's going to naturally resolve itself. We shouldn't overreact to triggers, hence the early warning system to the early warning system. But in some cases, a breach of a trigger may not be temporary, and it could push you to take action sooner than later. Limits, there should be no negotiation. You breach a limit, you must take action. What those actions are, it could mean dialing back growth in your capital plan. It could mean even shrinking your balance sheet. It could mean cutting back on capital actions or eliminating capital actions. The goal is to preserve capital, and each situation needs to be evaluated on a case-by-case basis. But the key is that breach, whether it's a limit or a trigger, particularly in the case of a limit, is telling you when you need to take action. So let's just quickly recap what we've learned in this video today. Number one, every financial institution should have two playbooks: an offensive playbook, which is a strategic plan, and a defensive playbook, which is a capital plan. The capital plan is particularly important because it contains the alarm system that will protect your bank and tell you when action may be required or when you may need to deviate from your strategic plan. That all being said, if your alarm system is well designed and it's not going off, then you should consider the coast to be clear and you should be able to pursue your strategic plan with plenty of conviction. If the alarm system goes off, you may need to take action and you may need to modify or even throw out your strategic plan, and you should be prepared to do so. Trust your alarm system. But the capital plan is tangible. It's a written document that can serve as a compass for guiding you through this uncertainty, and it gives all of your stakeholders, your directors, your regulators, your auditors, your shareholders, comfort that your financial institution is prepared for a recession, but at the same time, you're not paralyzed by one either, and you're not leaving opportunities on the table. We have some questions. We have a few good ones too. Let me read the first one. How do you set the limits and triggers in your capital plan? Stress testing is a great tool to use to quantify limits in your capital plan for both your capital ratios and many of your KRIs. But your stress tests have to use the right techniques. They can't just be check the box stress tests that many community banks and credit unions use just to make the regulators happy. Second question, are my strategic plan and capital plan two distinct things? Your strategic plan and your capital plan are two distinct things, but they must talk to one another and feed off one another. For example, if in your strategic plan you have an aggressive growth strategy, it's going to require that much more capital to support it. If capital is a finite thing and you're putting more of your capital towards offensive purposes in your strategic plan, it also means there'll be less capital available for defensive purposes to absorb and buffer risk. And as a result, in your capital plan, you will have to compensate for that by having higher capital limits to reflect that more aggressive growth strategy. And you may need to iterate between your strategic and capital plan to find the right balance between the two. Third question, we have a decent amount of unrealized bond losses due to increases in interest rates. Should they be in my capital plan, or should I ignore them since they don't impact regulatory capital? You absolutely must capture the risks associated with unrealized bond losses in your capital plan. And you can do this in several ways. With many banks and credit unions, I've recommended to them to have a tangible book value to assets ratio as a key risk indicator, because tangible book value will capture unrealized losses in the available for sale securities portfolio. If you have a large amount of unrealized losses in the held to maturity portfolio, then consider using the EVE ratio instead as a key risk indicator in your capital plan. Thank you for watching this video. Please subscribe to our channel and we'll see you soon.